Okay. There we go. There we are. Okay, let's get rolling here. Thank you. Thank you to everybody that stuck around to talk about resident taxes. I really appreciate it. I know it makes for long training. I do, but we do really need people that will do resident training because a lot of our clients, right, once they are here long enough, they become residents. And usually that's when things start to get very interesting for them. So we're going to do just kind of a quick introduction to federal tax for residents. We're going to talk about the IRS shenanigans some more. Then we're going to talk about filing status independence. So we're going to talk about some of the kind of the basic building blocks for a resident tax return. These are the determinations that you need to make. What is their appropriate filing status? Who is a dependent for them? Or are they themselves a dependent? All right, we're also going to talk kind of about some differences between the resident and non-resident training model and go from there. Okay, so when we compare the two types of taxes and how we teach them, in all honesty, the resident training does have a lot more material, right? Because 100 years of social engineering, and that social engineering has been focused on people that are citizens and tax residents of the United States. So there are many, many, many more credits and deductions and benefits that possibly could apply. Not that we see a lot of those ones, but there are more that could apply. The residents or the non-residents, they have less material, but it's all very, very specialized, right? It's really, they just kind of use some separate rules. So it's unique. The publication, the main publication that we use that the IRS puts out, IRS publication 4012 is for resident taxes. It is a monster. It's like 300 and some pages long. IRS publication 4011 is a little guy. It is something like 20 pages or something like that. It is much smaller. The residents, I already talked about this, right? They're taxed on their worldwide income. The government doesn't care where it's coming from. They still want their piece of it. Non-residents only have to pay tax on U.S. source income. So money they earn working here in the U.S. or from sources here in the U.S. A huge advantage for residents, right? The tax software that we use, it is designed for residents. It has built-in guides, it has assistance, it has little pop-up things. It says, hey, are you sure you want to do this? Or, hey, like, here's some common situations. Like, does this apply to you? Generally, there usually are like a few issues that they're working through kind of at this time frame because they're in the process of updating the software. But usually it works correctly and it actually like helps you do the return properly. For non-residents, the tax software can be made to do non-resident returns, but it is a can be made, not a, and it's designed to do that. So there aren't any built-in guides or assistance. And occasionally we have to kind of enter something that is wrong to get the return to actually show up correctly. So this is why our clients can sometimes need a lot of help because the software itself doesn't have all of that built-in help for non-residents. But for residents, right, the software is your friend. Now, normally for the IRS test, for the non-resident side of the world, we're not going to talk about software. We're going to do everything by hand. We're going to use PDFs. We're going to fill them out. We're not going to do anything in the tax software. For residents, we generally will do the software to help us prepare returns during training, right? It's built for it. It's designed for it. It makes our life easier. And once it's validated, then we can rely on it to help us out. 2025 is special year again. All right. So let me say a couple more words on that. So I mentioned this before, right? That the people that update all of the publications, right? A lot of them left before the OB3 happened. So a lot of the publications are not updated. So our 4012 that we use, right? If I look at some of the numbers in that, those numbers are wrong. The tax software, I believe they are in the process of updating it to be correct, which is good, right? We want them to do the right numbers for a proper return. But when we do our tax test, we're using tax references that are incorrect, and the tax test is based on numbers that are incorrect. So it is going to be a challenge for all of us to try to keep this straight. All of the VITA programs across the United States are all dealing with this. We're all banding together and moaning about it to each other. So we're not alone in this challenging situation. The IRS is aware of it, right? But there's just not a lot that they can do to fix it in this particular moment in time. So we are all going to work together to be as successful as we can. Just recognizing, right, that what we do to pass the test may not be the way we actually do it in reality for our clients. And so when we get in front of those clients, we're going to make sure that whatever references you have, like if I give you a 4012 so that you can have it to talk with the clients, it will be like written all over so that the correct numbers are in there for you to use. All right. Okay. So again, reference materials are your friend, will make them be your friend, right? In particular, right, the 4012, I should have brought mine. It's like, it is really truly this thick, like it is horribly big. But online, it's super great because they have everything linked. So you can like search key terms, you can like link from the table of contents or the index to like find the particular thing you want. So that makes it much more efficient to use. We're going to spend a lot of time in our tax training talking about material that you're going to see a lot of in our tax clinics. There is also going to be material on the test that we're not going to talk about as much in our training because we don't really see it. So if you think about our clients, right, they are students, scholars, teachers, researchers. We do not tend to have a lot of individuals that are retired that come to our tax clinics. So although Social Security income and retirement income is a big part of the test, not a big part, but it's a key part of the test, we will talk about it a little bit, but know that we're not going to see a large number of those types of income documents coming through our clinics. So we'll talk about them, we'll do a little bit of practice, but we're going to spend a lot of practice on things that are much more common, like scholarships and wages and education credits and things like that. Again, I'm going to remind you, ask for help, particularly as we are dealing with the challenges of, hey, like, here's this thing, is this the right number? Or, what should I use for this number? We're going to help provide additional support as we deal with the publication and tax law discrepancies. All right, I already talked about that. Yes, okay, so let's talk about filing basics. All right, again, right, so OB3, like it hit so many things, right? When we talk about social engineering, right, do they change the laws to like persuade people to vote for them and reward the people that did? Yes, they do. And that's, that's okay. They are the winners. That's their thing that they can do. So if you get married, if you have kids, you're going to get a bigger tax credit this year, which is great. If you buy a home, you will get a tax credit. If you wanted to do renewable energy like solar panels on your home, you do not get the tax credits after this year. If you buy a car that's built here in the US or assembled in the US, you get a new tax credit. Tax credit on tips, right? No tax on tips, no tax on overtime, additional taxes and deductions for retired individuals. There's a lot of really cool tax changes that can affect our clients and will hopefully result in some good numbers for them. So we're going to see there'll be a lot of new stuff. But tonight we're not going to talk about too much new stuff. We're going to talk about like the basics. And so when we think about like, what is the tax calculation, like the fundamentals of it? We start with income, right? We subtract adjustments, exemptions, dependents, or deductions. We get taxable income. We take it times the rate to find our total tax. We subtract our credits. We subtract our withholding, our payments, like money that's already been paid. We find out, hey, do we get some extra money back? Or do we have to give them some more? So let's talk about each of these in a little bit more detail, right? Income is like money coming in, but it's not actually just money, right? It's also things coming in, right? If you get crypto, that counts as income. If somebody gives you, like I say, Jair, dude, would you hook me up? I need some. I will come fix your plumbing issue if you will paint my house. We have not exchanged money, but we have bartered our services. That is technically income for both of us if we were in the business of being a plumber or painting houses, which I am not, thank goodness. All right, adjustments. Those reduce your income based on money that you have spent or saved. So if you spend it on the right stuff, you get money off your taxes. Exemptions, those reduced your income based on people. It's currently zero. It used to be like $4,500. Some states still have it. Right now it's zero. Maybe it's gone for good. We'll find out. But at least for right now, like having more people, having more in your family, that used to reduce your taxes. Deductions also reduce your taxes. There's a standard deduction that reduces your income by a set amount, or there's itemized deductions where you can say, oh, based on like all of these different things, if you spent more on those things than the standard deduction, sure, you can subtract all of that stuff. And we'll talk about all of these things in more detail. The tax rate is the percent of your income that you pay in tax. It is a progressive tax, and it's done in brackets. So there's a 10% for the first amount of income that you earn, then it goes up to 12%, and then 22%, and it kind of keeps going up and up and up. So as you earn more money, you pay more in tax. A credit will reduce the amount of tax that you owe. Some credits, non-refundable credits, will only reduce your tax down to zero. Refundable ones are the good ones, right? They will actually give you money back. So even if you never gave the government that much money, if you get a refundable credit, you might get more money back than you ever gave them. Withholding, that is money taken out of your income and sent to the IRS or sent to a state, and it's sent by the people that gave you the money. You work here at the University of Minnesota, they will withhold money in taxes. Federal tax they'll send to the IRS, state tax they'll send to the Minnesota Department of Revenue. But the university took that money out from you. You can also send money yourself. It's called estimated payments. Excuse me. And so you say, oh, yeah, I know, I have my business, I'm earning lots of money, it's super great. I know I'm going to owe a lot in taxes. Here's some for now, like we'll figure out the actual math later, but like here's some for now. That is an estimated tax payments. Individuals that have taxable scholarships. So scholarships that cover room and board, we'll talk about this more, but those individuals will often need to make estimated payments. So we'll talk about that one when the time comes. Let's talk about who has to file a tax return. So the truth is, for residents, it's actually kind of complicated. It's based on your age, your your marital status, your filing status, and your income. Sorry, lots of talking tonight. Okay, so, and even if you don't have to file, sometimes it can be to your advantage to go ahead and file because there might be one of those refundable credits where you get a bunch of money back. So if we look at our reference materials, publication 4012 has incorrect numbers for this, saying like based on your filing status and how much your age and your income is this much, you have to file. Those numbers are not correct. These new numbers down here are the bottom, where you have a standard deduction amount. If you are over 65, there is an extra amount that gets added onto your deduction, which is not new, that was before. And now there is this new bonus deduction for individuals that are older that don't have income over a certain limit. Pardon me. Okay. All right. So I'm not expecting you to be able to read this tiny table. And we will get the updated tables. It'll be, obviously this will be on the website and it'll be in all of our reference materials that we use for actual tax clinics as well. So, but no, basically there's a set limit. Below that, you don't have to file. So as we look at what the forms are, so I mentioned that there's a lot of them. So the 1040 is the general form, kind of the summary form. Schedule 1 has additional incomes, like other kind of less common types of income and adjustments. We'll use this for taxable refunds. Schedule 2 has additional taxes. This is not very common, but we might occasionally see it. Schedule 3 has additional credits and payments. This is very uncommon, but still theoretically possible. Schedule A has itemized deductions. We're going to talk about all of these in more detail. This is just kind of an introduction. Basically, remember that list. Hey, if you spend money on all of these different things, then it's more than the standard deduction, then you can just subtract that. This is a partial list of what those things are. Medical and dental expenses, state and local tax paid, interest you paid on a home loan. So if you have a mortgage, right, buy a house. We'll give you a discount on how much you pay in interest because you can subtract it on your taxes. Give to charity, help other people. You can subtract that on your taxes. And there are many, many other forms and schedules. And generally, it's pretty common to say, oh, there's this type of credit. There's going to be a form for that type of credit. And there's another type of deduction or exemption or whatever. There will be a form where they collect all of the information and do the math to calculate, the benefit for that form. You're only going to use the schedules or include them in a return if there's actually some information on them. So somebody that takes the standard deduction, they would not include a Schedule A on their return because they're not itemizing. There's nothing that needs to go on it. I talked about this a little bit already, right? Calendar or taxpayers are tax year or calendar year filers. They're cash basis if you are an accounting or finance person. So it's all about like, when did you actually get the money? It's not about when I promised to pay you, because that is not the same thing as actually getting the money. January 1st through December 31st. And then the returns are going to be due on April 15th. Dates are always going to be a month, day, year convention. As far as where we send the form, so we are going to be e-filing almost all of our resident returns. It should be very rare where we would not e-file, particularly for federal. Federal returns generally all get e-filed, so they won't generally have to mail them. We do see a few folks for state returns. If they're married to a non-resident who doesn't have a Social Security or an I-10, they're going to have to paper file their states. The mailing address for the tax return is going to be based on your physical location. There are tax processing centers kind of around the United States. TaxSlayer, which is our software, it'll print out filing instructions and it'll say where they need to mail it to which one based on their address. All right, the fund continues in terms of getting a refund. So the federal administration has eliminated paying refunds by paper check. They want you to do a direct deposit to a US bank, meaning a bank that's here in the United States, not the particular bank called US Bank. We are working to identify banking options for those that don't have a bank account. A lot of our international students in particular may have some challenges around this. Theoretically, there are supposed to be some limited exceptions for people that don't have to have direct deposit. There is not really any information yet as far as who qualifies. There is no information yet on like what exactly is the process if they do qualify for that exception. So for now, we're going to say we really want to do a direct deposit if at all possible and try to support people if they don't have a bank account by finding options so that they can quickly and easily and for free open a bank account here in the United States. All right, let's talk about filing status. So there are 5 filing status categories for taxpayers. They can be single, head of household, married filing jointly, and it matters whether they're living together or apart, but married filing jointly, married filing separately, and then qualifying surviving spouse. All right. And note that any filing status where somebody else can claim somebody as a dependent, they have a different threshold. So if somebody can claim you, let's just talk about that in just a minute too. So anyway, so those filing status, those determine the minimum filing amount you have, minimum income you have to file, and then the tax rates that you use when you file. So for 2025, these are the standard deductions. Again, I already kind of had those in my one table. There are some other impacts on that in terms of who has to file, but also your filing status does have one other very important effect, which is some filing status categories are not eligible for some types of tax credits. And in particular, right, the government meddling as they do, right, they encourage people to get married, and they say, oh, we want you to be married. We also want you to file a return with your spouse. So if you file separately, you're not going to be eligible for some types of credits, particularly if you file separately but you're living together. So how do we figure out what the right filing status is? So for single, right, that is basically not married. So they either could be never married, they could be divorced, they could be legally separated if they have a court decree, or they could be a surviving spouse, but they don't have meet the other requirements to meet the surviving spouse status. So, and this is always on the last day of the year. So December 31st, 2025, what was your situation? What happened before in the year, that doesn't really matter. From a tax perspective, December 31st, that's what matters. So let's say Scott, for example, his divorce was finalized on December 30th. He has no children. What would his filing status be? It's going to have to be single because he was divorced. He's not married anymore on the last day of the calendar year. Even though for 364 days out of the year, he was actually married. Because he was not married on that last day, he now files as single. If his divorce had been finalized on January 1st of 2026, his answer would change, right? Because he's married. So he would either have to do married filing jointly or married filing separately, right? He would have to talk with his ex-spouse and decide what he was going to do or what they were going to do together. Were they going to hold it together long enough to file together, or are they, really, really done, and they're going to file separately? Now, if Scott had children, there's a possibility that he might qualify for a different status, which is called head of household. And we'll talk about that in just a couple of minutes. Or on the next slide, because I forgot that it was next. So a taxpayer may file as head of household on the last day of the year if they are unmarried or considered unmarried, and they provided more than half of the cost of maintaining their household for themselves and that qualifying person who must live in the same household. So there are three tests here. They have to be married or unmarried, considered unmarried. They have to pay for their house more than half of the cost. And they have to have a qualifying person that they're supporting. So if you are, essentially on your own, taking care of a child, then you get the special head of household status, which gives you a more advantageous tax rate and a higher standard deduction, is what it does. So for that marital status, you are either truly unmarried or legally separated under a decree or divorced under a decree. Or if you are actually still married, but you did not live with your spouse for the final 6 months of the year, right? So think, things went really wrong. Your spouse ran off to Florida because it's warm there, and they couldn't handle the Minnesota winters. And they've been gone for the last, 10 months of the year. You're living on your own, you're taking care of your kids. That would be the time when you would say, yes, you would meet the criteria to file as head of household, even though you are still married. You have to pay for the cost of keeping up your home. That includes things like rent, repairs, groceries, utilities, or mortgage payments, all that kind of stuff. And then the qualifying person, that qualifying person must have been in your home for more than half of the year. Other than a dependent parent, if you provide a support for a parent, they don't have to live with you. But otherwise, generally, they have to have lived with you for more than half of the year. So, yeah. So a couple of examples here. Jeremy is divorced. He paid for all of the cost of keeping up his home for himself and his son. He can file as head of household, right? Because he's paying for everything and he's taking care of his son. All right. In the same situation, right, but Jeremy's son only lived with him for 3 months in the summer. He's not going to qualify as head of household. He's going to have to be single because even though he paid for some of the costs for his son, he only lived with him for 3 months. He didn't live with him for that 6 months that he's required to live. All right. Taxpayers can file jointly with each other, right? Spouses can file together. If one spouse died during the year, the surviving spouse can still file a joint return for that particular year. After those years, then they will have to file either as single or as a special, the next qualifying status that we're going to get to. All right. If they divorce, they actually have court documents, right? It's official. It's not just an informal, I'm done with you. It's like we're legally done. We're no longer married. Taxpayers who are married filing a joint return, if they don't live together, the threshold for filing is actually different, is actually $5 rather than the $30,000 or whatever it is. Right? Again, really weird rules that the IRS government has put in place, right? You're married, you're filing together, but you're not living together. We want spouses to live with each other. Otherwise, they're suspicious of like a marriage in name only to give everybody lower taxes. So, all right. You can file separately if you don't want to file together with your spouse. These are all of the credits that you don't get when you do that. So they really want you to do that. But for our students, right, most of them are not married. If they are, then, they have the choice if they want to file separately or together. So yeah, but it's generally to their advantage from a tax perspective to file a joint return together. All right, the last one is qualifying surviving spouse with a dependent child. So for the first 2 years after a spouse has died, the surviving spouse may use this special status that basically gives them kind of the same filing requirements and tax rates as a married filing joint return. So if they could file a joint return in the year that the spouse died, whether they did or not, if they were able to, that would qualify them as long as they still have that dependent child living with them. So if the spouse died in 2023 or 2024, they could still do that in 2025. They also cannot have remarried. So as soon as you remarry, this qualifying surviving spouse status is no longer available. All right. They have to have a dependent, a qualifying dependent to be able to use this status as well. It's either a child, stepchild that live with their taxpayer, or someone else that could be claimed as their dependents. All right. And in this one in particular, the child must have lived with them the entire year rather than just half of the year. All right. I will say in our tax clinics, right, we see probably 85% single filers. The vast majority of the ones that are not, they're filing a joint return with their spouse. So we do not see a lot of married filing separate status. We see an incredibly few number of qualifying surviving spouse status. All right. Filing status can have an impact on a tax return in a couple of ways. All right, it impacts your tax brackets, it impacts your deductions, it impacts how much credit you can claim or what credits you're able to claim. Right, head of household gives you a different tax bracket and a higher standard deduction. Married filing joint, everybody combines their income, doubles the standard deduction, doubles the tax brackets, so it can reduce the tax rate that you have to pay. Married filing separate, right, everybody files on their own, but sometimes that can actually be slightly to the advantage of one or more of the spouses. But they also can't claim a lot of the tax credits. Then the qualifying surviving spouse, right, that gives them the married filing joint bracket and standard deduction, which is great. All right, here's our reference numbers again. All right, it's just the review. There's more information there. Let's talk about dependents, and I think that's our last thing for tonight. So what is a dependent, right? So this is a dependent for tax purposes, not a dependent for visa purposes. And it's basically a person, so it's got to be a real person other than the taxpayer or spouse that entitles the taxpayer to claim a dependency exemption as defined by the IRS, which is very circular for a definition. So in 2025, there is no federal deduction for exemptions because they've kind of rolled that all into the standard deduction, but claiming a dependent can provide for some tax credits, and there are state exemptions that can be available as well. All right. Okay. think my thing is set up to recognize gestures. That's what's going on. All right. So there are a number of tests that a dependent has to pass to be able to qualify. So, and this is really kind of a handshake. So the dependent has to meet these tests, and the person claiming them also has to meet some tests. And if they both are met, then there can be a dependent that is claimed. And for those tests, there are two sets. There's a qualifying child test, and there's a qualifying relative test. So we're going to talk about what those are. To be a qualifying child, there are 6 things that have to be passed. You have to meet a relationship test, right? They have to be your actual child, stepchild, foster child, or a descendant of them, like a grandchild, something like that, or your sibling, half sibling, step sibling, or a descendant of them, so like a niece or a nephew. So think about it as like yourself and down in the generation map, or out and then down as well. But it cannot go up to like a parent. It cannot go up to like an uncle or a grandparent. There is an age test. They have to be under age 19 at the end of the year and younger than you and your spouse if you're filing jointly. They also could be a full-time student for 5 months out of the year and be under age 24. So this is a lot of our clients, right? A lot of them are college students, so they are often students under age 24. So that means that they often will meet at least that age piece of the dependent qualifying child test. You can also be permanently and totally disabled, and if you are, then it doesn't matter what your age is to be able to be claimed as a qualifying child. There are 2 residency pieces. Number 1, you have to be either a US citizen, resident alien, national, or a resident of Canada or Mexico. Then you also must have lived with the person that's claiming you as a dependent. They must have lived with you for more than half of the year. And there are some exceptions for temporary absences, such as, if you were born during the middle of the year, you obviously can't have been there for more than half of the year. There are also absences for education, military duty, vacations, all that kind of stuff. All right. There's a support test. The child can't have provided more than half of their own support. The child can't provide or can't file a joint return. They are married and filing a joint return, they are no longer a dependent. And then you must be entitled to claim the child as well. Sometimes there can be multiple people that could potentially claim that child. So to meet the qualifying child test, you must be the person entitled to claim the child. There is, in the 4012, there's a really good kind of flow chart to figure out who can be claimed or who cannot be claimed, or who is the right person to claim a child. The good news is this part of the tax law did not really change very much. So our references for this piece of it are still quite valid. So if you don't meet the qualifying child test to be a dependent, you still might be a dependent if you meet the qualifying relative test. And so that one is a little bit simpler. And the first one is very easy, right? You can't be a qualifying child. If you're a qualifying child, that's what you are. There's no talking about being a qualifying relative. The next one is that you must be a member of your household or have a certain relationship. So they either have to live with you all year or be related to you in one of the ways of people who don't have to live with you, which is generally like parents or people that you support in your family. Excuse me. All right, if they were married to you at any point during the year, they can't be your dependent as well, or qualifying relative. Yes. So that means that you can claim as a dependent, potentially, like if you are living with somebody and, right, they've had a rough year and they have paid no rent and, you pay for all the food, they're basically your dependent, right? If they have no income, you could claim them on your tax return and maybe get a little bit of money back for all of that rent that you paid for and all the food you paid for. The next test is a gross income test. So that person's gross income must be less than $5,200 in a year. This again is all money, property, and services that isn't exempt from tax. And then the support test, right? The taxpayer must have provided more than half of that person's support. Then there's another like set of, if there are like multiple people who are providing, how do you figure out who it is? So It's not very common that we see people with qualifying children or qualifying relatives. It's much more common for our clients to potentially meet the criteria to be a qualifying child or a qualifying relative. All right. Here's this in kind of another version of how that works. Some more notes on that. Let's talk about the impact. So dependents really are, the benefit there is additional tax credits. So a child tax credit can be up to $2,200 for children up to age 17 for 2025. There are education credits. So up to $2,500 can come back for money that's spent on qualifying education expenses. The head of household filing status is a significantly higher standard deduction. So that's a bunch of additional income that you can receive that you don't have to pay tax on. And there could also be a lot of state income tax benefits as well that can really reduce the amount of tax that you owe. So having children, having dependents is definitely a tax benefit. All right, let's go back there. So again, there's only two kinds: qualifying child, qualifying relative. These are the tests. The tests here basically aren't changed, so your 4012 is going to be a good reference guide for those. Generally it's good there. All right, the things I'm going to say on this, right, is that this is really complicated. This is like one of the more complicated things. So the filing status and dependency evaluations, those are kind of the building blocks for when you start to do somebody's return. What is their filing status going to be? Are they a dependent of somebody else? Can they claim anybody as a dependent? Those are kind of really the beginning steps that you're going to need to work through before you can file a return. And our clients in particular, right, most of them are students in that 19 to 24 year age range. So they very well might be claimed or be able to be claimed as dependents, and they might not be. So figuring that out first. You know, when you're trying to figure that out, start with the qualifying child test first. Look at their relationships, look at the age, look at their residency, where they live, look at who's supporting them, like how are they paying for school, right? Where does that money come from? It's no matter what school and what volunteer organization you're at, right? College is very expensive, so it takes a lot of money. So how are they getting that money? Are they providing it themselves? Are they doing loans? Is their family providing it? If they're not a qualifying child, are they a qualifying relative, right? Basically, were they living with that person all year? Is their income below that threshold? Is that other person providing the support? And that status affects their credits that they're eligible for. They can be claimed. All right. Any questions on any of that? All right. I know that it is a lot, especially on top of all the non-resident stuff, but we are done here early. Are there any questions online? All right. Let me do this. I think we have a little bit about Moodle here as well. Yep, so there are going to be two online Moodle courses. There's a non-resident course and there is a resident course. The first thing that you do in the non-resident course is there is a volunteer information survey. You answer a few questions, and one of those questions is, do you want to train in resident taxes? If you say yes, then I will add you to the Moodle course for residents, and you will go on from there. Same things about the tax training, why we do this, right? I think this is going to be even more important here for 2025 because we know some of our reference materials are a little sketchy, so we'll put all of our additional resources out there. Same skipping and all that kind of stuff, same things. You'll have in the volunteer readiness check, there'll be one resident scenario that you have to complete as well. So 2 non-residents, 1 resident. All right, we're gonna have 2 homework kind of like information, like some reference information guides, and then quizzes, 1 for filing status and 1 for dependence. So determining is so-and-so a dependent, or who can claim so-and-so? What is the best filing status for Joe? What is the best filing status for Jane? You guys will see the invitations for those as soon as I get the regular Moodle out to you tomorrow morning. You get that survey sent out. Okay? All right. Last time, any questions?
Are these slides published yet?
These slides will all be published out in the Moodle as well. So they'll be out there. The links are all live. I have a lot of the reference materials like the IRS publications and forms. Straight links to those are all out there also. So, okay, that is everything. I'm going to stop and I will see you all next week.